Why is it common to award equity or an ownership interest in the business to some of your early employees in a startup venture? Well, the reason is pretty straightforward. You can't always afford, as a startup, to pay skilled, talented new employees their market rate. In a startup, you're using all of your available resources to try and grow or to gain a solid footing in the business. So with that being said, you still need these talented individuals, but in order to incentivize them, you have to give them potential for the upside of the business being successful or growing. So you award them an ownership interest in the company in exchange for a portion of their salary. So if the going rate in the market is $100,000 and you can only pay $50,000 to $60,000, you're going to have to offer an equity incentive that brings them on board with the expectation that they could make up that difference in value at some point in the future. Now, how do you award an ownership interest to new employees? Generally, it's in one of two ways. You can award them shares of ownership interest in the company, that is, shares of stock or membership units in a LLC. But to do so is not always advisable, usually because awarding shares immediately suffers tax consequences that are not necessarily favorable to the employee. Also, it may not be the most advantageous to dilute the ownership interest at the moment by offering shares and bringing the employee into the ownership pool. Rather, allow them to vest in an ownership interest over time in the future after a trial period. And that is best done through something called stock options. Stock options are the ability to purchase an ownership interest in the company at the current price, and that's an important thing, at the current price of the stock. And oftentimes for a startup, that requires the company to go through a valuation process. If it's a brand new company, the company may have no value yet. So awarding stock at that point would be just at the par value of the stock that you authorized as part of the formation process. But with that being said, you value the options and you award them the right, a contractual right, to purchase an ownership interest at that current price. Well, that doesn't have any immediate value. It only has value if the value of the company goes up. And in a startup, the essence of the startup is it's going to grow. It's going to become more valuable. So the employee gets something of no value that they don't have to pay taxes on because it's at the price at which they can purchase the stock is equal to the current price. So the benefit there is zero at this point. In the future, when they exercise that stock option, then they have a capital gain rather than receiving that stock as compensation at the time. So that's a huge benefit. And there are specific plans in place that allow employees to vest in an ownership of stock over time. Generally, a company will adopt a stock option plan where they can award qualified or stock options to employees, or non-qualified stock options or non-statutory stock options to employees or outside third parties such as contractors who provide services for the business. So with that being said, stock options is generally the better route. Now, how do you determine how much value to grant to the employee? Well, if you're going to award an equity interest, this is based upon the current value of the company and the value that the employee brings, just like calculating a salary. If you need to replace whatever you cannot cover for the employee in terms of salary, you're going to project the current value of the business, and then you're going to offer a percentage ownership in the business equal to that valuation. Now, an early stage business is extremely difficult to value. It's extremely difficult for investors and internal owners. So usually there's an approximation, a very general back of the envelope approximation for valuation, and they award an interest more based on the value that the employee brings to the company and whether the employee is a long-term fit or value for the company. And if they are, if the employee is essential to the future growth and value of the company, then awarding a larger percentage of interest or options to purchase a larger percentage of the company's outstanding stock is more likely. So there is no good means or method except for to say that you look at comparable companies in the market, in the industry, and see what their valuation is when they are going through an equity funding round, or just similar businesses that have been purchased by larger strategic acquirers in that industry, and try to go from there with a valuation. It's easier if the company itself is going through an equity funding round, because generally they ascribe a valuation to the company prior to investment and post-investment, and that valuation can easily be used and say, we want to give you a prospective interest of $50,000, so here's the company valuation. This is the shares of stock or the percentage of stock options that we're going to award to you based upon this valuation. So the answer to the question of how much equity compensation should you give to new employees, ask yourself, how valuable is the employee to the company? And then you can compare that to the value that other employees bring to the company, and consider how long they've been in the company, how much risk they've put up, how much of their own personal assets they've invested in the company, and that will help you come to a calculation of what to offer the employee as incentive to remain as an employee of the company.